Do you want to build lasting wealth? Well, property investing might be the key. Now, my name's Luke, and I talk all things real estate, renovating, and financial freedom here on the channel. And my wife and I have been blessed to build out over a $5 million property portfolio that gives us choices. And that is the most important thing. I don't think rich is probably the right target, but wealthy is probably what I'm more looking to achieve. But as the title says, how are you going to get rich and stay rich? Well, to get rich, you need to build an asset base, whether that's through a business, through shares, or through property investment. Or the more popular strategy in the last few years has been crypto investing. But for me, I think it's property. So why property to get rich and stay rich? Property has been around forever. People have been fighting for kingdoms, fighting for land, and in more recent years, fighting in the Sydney market to battle it out on a Saturday afternoon at auction, bidding millions of dollars to try and get the family home. Now, property is a scarce resource. We have a massive country here in Australia with tons of land, but everyone wants to be where the amenities, the infrastructure, the lifestyle, the community, where the people are. And that means the land in these inner city and urban locations and with lifestyle opportunities near the beach and the bayside have seen significant demand. Property is also a long-term asset. It's not an asset that you jump into and you're going to make big money in a short period of time. Granted, we have had a COVID period and lots of money printing, which has significantly pushed up property prices over the last few years. But that was really driven by the RBA and the government through some printflation. For me, property is a secure and stable asset over the long term. It's driven by owner-occupiers. 70% of the market is going to be owner-occupied when they're making a property purchase decision. And that means people can get emotional. They want to pay more money for their family home. They're willing to upgrade and spend extra money. And also there's always going to be a pool of renters. Whether that's by choice or because they can't break into the market, there is always going to be people who want to rent a property and therefore have shelter over their heads. And that means people can look to invest in these assets. It's going to have stable yields. People are always going to want to rent these types of properties if they're in good locations and in reasonable condition. So between the capital growth and ability to add value to homes, as well as the cash flow, that's why I think property is one of the best investment vehicles to grow your wealth. So let's break down the steps to build this wealth. In my opinion, you can go one of two ways. You can go the long, slow route where you buy property and you hold it over 20 to 40 years, and eventually you become wealthy like a lot of the baby boomers at this point in time. Or you can look at option two, which is do your research, look at the market trends, look at ways to add value and fast track your property portfolio and create wealth faster that way. That's exactly how Emily and I were able to build our property portfolio. It's one step at a time and looking to build on those building blocks to continue to grow the asset base. So for Emily and I, we used everything at our disposal to break into the market. We used a scheme called the First Home Super Saver Scheme, which enabled us to save about $5,000 each on our tax and to build up a deposit a little faster. Together, we saved $66,000 and purchased our very first home for around $800,000 in 2018. So that is the first step. You've got to get your foot in the door. You're not necessarily going to be able to buy an $800,000 home, but what can you afford and how can you get a deposit together to buy and start building the asset base? Once you've got your foot in the door and you've secured that first home, are there ways that you can manufacture or fast track growth? Have you bought in an area with short to mid growth potential? Have you bought a property that you can cosmetically add value to through renovations? That's exactly what Emily and I did to continue growing our property portfolio. So we got our hands dirty. Yes, I might have been an accountant or what people like to call a pen pusher or a bean counter. I was an accountant, but also on the weekends and weeknights, we got out and started painting and started sanding floors and got our hands dirty and tried to add value. You're not always going to be successful, but if you're willing to put in the hard work and learn, this can be a great way to ply a trade and save lots of money in the process and manufacture value on your home. You can also do this with an investment property. So if you don't buy your first home as your own home, maybe you buy an investment property and you rent vest. If you're able to manufacture value, this can allow you to fast track your equity or growth and allow you to refinance again to build the asset base. So this leads me into the step number 2, which is understanding the finances. You're not going to get rich or stay rich unless you can manage the debt and manage the equity in your property portfolio. This is where a lot of people become unstuck. Should I use an offset account? Should I use a redraw? Should I refinance my own home? Should I have a split loan to do that? How does it all work? I'll try and make it as simple as I can for you. The way we like to think about it is you want to maximize your good debt and minimize your bad debt. Good debt is debt attached to your investments. Bad debt is things like cars, credit cards, and even your own home, unless you're able to refinance your own home down the track and pull out further equity for future investments. So build up your good debt. Buy other investments. So if you've got one property in place, if you've created value in that home through a renovation, or the market is uplifted in terms of value, go back to your broker or your bank and ask for a new bank valuation. Once that bank valuation comes in, you'll typically be able to pull out 80% of the value as more debt against your own home. Now take away the current debt you have, and the remaining balance will be the amount of money that you can put towards your next deposit for a property purchase. This is otherwise known as equity harvesting and allows you to pull out your equity, secure it against a property, and use those funds to buy another asset. This is the finance game. If you can't understand how to use equity and how to manage your debt, then you're never going to be able to build a property portfolio at scale. The other thing I'd like to mention in step number 3 is balance between capital growth and cash flow. Now, everyone's going to be in a different circumstance. Some people might be earning as a household $200,000 to $300,000 a year. Some households might earn $80,000 to $100,000 a year. For different people, there's going to be different property choices and different borrowing capacities in terms of what assets you can buy. If I was starting out on a much higher wage, I would be very growth focused. I'll be looking to buy big capital growth assets and build the asset base fast from a growth perspective. If I had slightly lower income, I'd be looking for more of a balance. Still leaning towards some growth, but maybe I have less borrowing capacity and I can only buy a $500,000 to $800,000 home rather than a $1 to $1.5 million property. So in that case, I would still be growth focused, but then looking to also balance the cash flow given the current interest rates. As you build out your asset base, that's when you can start to look to transition and consolidate and start to bring in some more cash flow. And that's the next step. Find balance in your property portfolio. No two journeys are going to be the same. Your journey in property investing is not going to be the same as mine, but the large and overarching principles to create wealth can be very similar. So for Emily and I, we went for growth first. We bought 3 capital growth potential properties with very strong underlying land component, with the ability to add value through renovations in sought after locations here in Southeast Queensland. For each of those properties, we did a renovation when we bought the home. We spent between 3 to 8% in terms of the value of the property on the renovations. And after we completed the renos, we went back to the bank and refinanced and increased our good debt to continue to grow the asset base. Now, after doing that and building out our capital growth properties, it was then time to look at cash flow assets. And that's when we purchased the unit block in Coffs Harbour. This was a monumental purchase for us. It was a big decision. It was a property that we bought sight unseen, and we purchased it for $1.4 million. Now, how on earth are you going to finance a $1.4 million unit block purchase? Well, it's by going back to those growth assets and refinancing out the debt to use those funds for that next cash flow purchase. Now, it doesn't have to be a $1.4 million unit block. As you look to transition your property portfolio into a bit more cash flow to make it easier to hold, then you're going to look at buying maybe a house and granny flat setup, or buying some townhouses with a high yield. Every investor is going to be different, but there are different strategies, even Airbnb or different types of short-term rental strategies that you can look to increase the debt. Another popular strategy, which does have higher risks, could be rooming accommodation or boarding houses. So there's so many different strategies you can look at to boost your cash flow. And a popular one that we do with clients is that house and granny flat strategy, where you buy the house, you add value through a renovation, and then maybe in 3 to 5 years time, you come back and add a granny flat to boost the cash flow. So we've talked about getting rich. You've got to build your asset base. You're going to get compound growth on that asset base, and you're also going to have rental income to allow you to hold the property portfolio. Now let's talk about staying wealthy or staying rich. How on earth are you going to do that for a long period of time and not let this property empire or property portfolio crumble over the years? One of the important things here is not overextending yourself. There are investors out there who have taken massive risk to get where they are today. I've heard of guys with, 10, 20, $40 million portfolios who were leveraged to the hilt and banking that the market was going to go crazy. Hey, those bets might have paid off for them, but I think you've got to manage your risk. The way you manage your risk is you make an educated and informed decision. Now, I run a buyer's agency here in Southeast Queensland called Purpose Property, and this is what we help our buyers do, whether they're buying their own home or an investment property. We help them make an educated and informed decision. The way you do this is you look at the data, you look at the numbers, look at the quantitative and qualitative data, work out what suburbs are going to meet your buying criteria, and then also run your portfolio numbers. Make sure you're managing your tax returns. What are your positive or negative gearing looking like on each of those properties that you own? What are your plans moving forward? So it's about being strategic, analyzing all the information available to you, but not getting information overload. I don't plan my property portfolio out to a T. I don't need to know a 4.1 or a 5.3 or a 7.6% growth rate. I don't need to know hundreds of variables. I do need to know the big picture. So where are we going at the big picture? We want to build this asset base. I'm going from $5 to $10 million in the next 5 years. That's the big picture. The steps to get there is I know I need to buy more assets. Okay, so what assets am I going to buy? Maybe I'll buy a motel. Maybe I'll buy several house and granny flats. Maybe I'll buy a couple of unit blocks. So I know the big picture and then I work backwards to find the right opportunity for me. It's the same for yourself. To create this wealth and then to hold on to it, you need to maintain and be educated and keep your finger on the pulse in terms of the numbers. There are also great ways to manage your taxes and your maintenance, for example. Use a property manager. These people will take a lot of stress off you so you can focus on the big picture things. When it comes to your taxes, keep clean records. Make sure you have a bank account for each of your properties, so when it comes to tax time, you can just print out the statement, look at the income, look at all of the expenses, match that up with your rental statement that you get from your property manager, and have very clean accounting records. Another important factor in terms of staying wealthy or staying rich is that you do take a little bit less risk once you've done all this hard work. Once you've built your property portfolio, you don't need to take on 90% LVRs. You might want to reduce your LVR a little bit. You might want to have some more cash flow coming through the portfolio, and that's why you consolidate and maybe sell down some assets like Emily and I have done recently. So when you get that asset base, $2, $3, $5 million plus, you might take a little bit less risk and be a little bit more strategic about those next steps that you're going to make to ensure you retain your wealth and that you're managing your cash flows moving forward. Of course, this can all be made easier if you have a very high PAYG income, so you're a doctor or a lawyer or a high earning accountant, or you run your own business and you have massive amounts of income through that. Obviously, people who are making a lot of active income can push that into more passive assets like property investment. On the flip side, you don't need to have a massive income. Emily and I started investing when I was earning $55,000 a year. My wages for the first 5 years of my career were $45,000, $55,000, $60,000, $80,000, and $100,000 over a 5-year window. We weren't earning massive amounts of money, and it was a slow grind in terms of saving and building our wealth. So don't look at someone else's journey and compare yourself to them. Don't even compare to me and what Emily and I have done in our journey. You need to focus on what you're doing, what you and your partner are doing if you're a couple, and how you're working towards your own end goals. I think get rich is probably not the right term to use. I like to use the word wealthy because that indicates a different type of status. It's a longer term period. It's about creating more choices. Rich to me just means choices. Choices to spend time with my family, to focus on my faith, to enjoy playing football and going to the gym, and having flexibility with my time. I want to be able to shoot these YouTube videos, spend time with the kids. That's why I have a studio at home, because I don't have to be out on the road or out in the office all of the time. I get to create my own calendar and work with clients who are motivated and have similar goals and strategies to me. So I think this all comes down to what your definition of wealth is, or what your definition of rich is. Create a definition that means something to you. I don't think you should be chasing flashy things. It is nice to have things that make your life easier, but to a point, money is only going to get you so far. It's more about the relationships and the choices that you have that are going to actually make you feel wealthy. Now, I've got hundreds of videos on this channel, but if you want to have a more detailed chat and you're looking to buy a property here in the Brisbane market in the next 3 to 6 months, then head over to purposeproperty.com.au. We'll sit down, talk about your situation, talk about what we do here as buyers agents here in Southeast Queensland, and then have some time for some questions. If you want to see a video that YouTube thinks you'll really like, then make sure you click this video over here. Thanks for sticking around. I'll see you in the next one. Peace.